Okay, I had a student who asked me to do a little thing on the internet and the stock market, and I think that the person wanted me to look at two things. One was how has the internet, just in general, affected the stock market, and then how has the internet been able to affect the share price when people get together, sort of like what happened in the movie Dumb Money, which is about GameStop. So here, the first one, here's a bunch of happy people, who are on the internet. They're happy. They've got their computers. To be fair, the internet hasn't done shit for them. The internet has given them access to more information, much of which people don't understand. It's given them the ability to trade more frequently if they want to. I have a Fidelity investment account. I can buy and sell stocks or bonds all day, and it's free. I'm awful at it, and I don't do it very much. I have a couple $100 in there that I mostly just show kids how stocks work. And so I'm really shitty at it. Best man at my wedding is a financial advisor and tells me what to do. I routinely don't do it and have no money in the stock market because, well, in my Fidelity investment account anyway. So anyway, these people, you can buy and sell more easily now. You can do it on your own now. You don't have to have a stockbroker now. But there is very little expertise that we've seen. We don't even know that from the macro perspective. And obviously there are differences. There are people now who can get the information, make decisions with it, make good decisions and make money off it without the help of a stockbroker. But those people still haven't affected the macro problem of the fact that the 1% owns half of all stocks and the bottom 50% owns 0.5 of all stocks. Right, the internet hasn't made that any better. The internet hasn't flattened that out. It was supposed to. Like many things, the internet hasn't changed our ability to create as much productivity as we wanted to. It doesn't democratize things as well as we wanted it to. In fact, it's actually led to less democratization. And having all this information is great and it's good. It's still oftentimes out of the parameters of understanding for most people, and so for them to use their own money to make decisions on information they understand is oftentimes not done very well. And that's in any case. That's with stocks, that's with politics, that's with anything. And so for your average dude sitting at home, the stock market is a bit of a bust unless you want to be able to look up the share price of Walmart really fast. And then the internet's great. But in terms of like your average dude getting ahead because of the internet, that hasn't really been shown to fruition, at least in a macro sense. That doesn't mean that individuals can't do it. It just means in the macro sense that has not happened. Now, the one thing that did happen that was interesting, which is why they made a fucking movie about it, is what happened with GameStop, okay? And the internet did do something with that, but it was also an outlier. And they were also crushed by hedge funds. And, you have all these, politicians who get funded, and their campaigns get funded by people who make money off of the stock market professionally to make it so these people have a really hard time doing that. I mean, the problem is that even though we have information at our fingertips at our disposal, that doesn't mean the rules are bent in our favor, particularly when it comes to any sort of collective action. So here's what happened with GameStop. So there's a dude, and he actually is, here's what he looks like, all right? And he is a trader, not like a trader in our country, but like he's a trader at some firm, and he finds that GameStop, which is a store that you can go into to buy and sell video games and accessories, etc., the GameStop has been undervalued. He's looked at its internals, he's looked at its projections, its revenue, its debt, whatever. He's looked at all that stuff and determined that it's undervalued. And he's telling all these people about this. And so let's say the stock was at $5. Let's say there's 1 billion shares, or I have no idea how many shares there are. Let's look at this graph real fast, by the way. That y-axis is this is share price. I think it actually started off closer to $3 and change or something like that when it started going. But I'm just going to make it 5 to make the math easier. All right. And then the y-axis is going to be our quantity of shares. In this case, the supply of shares is vertical. It's finite because there is a finite amount of shares. Companies can choose to release more shares on the market if they want to, which would devalue the individual price of the share. But that still would just change. It would change the supply. It would stay vertical. So there's a finite amount of shares out there, which is why supply is vertical. The demand curve I have is being downward sloping. It can be a little bit more horizontal. It can be a little bit more vertical depending on the elasticity for that specific stock. I have no fucking idea what the elasticity of the GameStop stock was in 2020, so I apologize for not knowing that arcane piece of bullshit. But either way, this is what it looks like, all right? And then you've got this hedge fund guy over here, all right? So let's say, and I'll use green here, let's say that the price is $5, and these fuck-ups over here, they see that a bunch of retail sort of individuals, internet retail, share buyers, right? That people who don't have access to this information, who don't do it professionally. Usually hedge funds will prey on people like that. Hedge funds tend to bet against the markets. It's a way to hedge against the bet to make sure that they're always making money. They also oftentimes have access to large amounts of capital that many people, in fact, most people, in fact, very, very few people have access to that kind of capital in which to move a market, right? Particularly one that's as unimpressive as the GameStop market, okay? So you have some dudes over here at the hedge fund market, and they're gonna do a short, all right? They're gonna do a short, which means they think the GameStop stock should plummet based on the number of factors that they deem. And a lot of it was just they saw that these people up here were trying to drive the demand of the stock up, which would, they, in their mind, be an artificial increase in price. So they thought shorting the stock would be a great idea. And what it happens is, if you're a hedge fund guy, you usually go to some sort of investment firm or another hedge fund, or maybe you have capital on your own. And what you'll do is, just like any other stock, you want to buy low and sell high, right? So what they're going to do is they're going to borrow money, and they're going to go ahead and sell the stock. And let's just say it's at $5, which I'm just making up. Let's say it's at $5, all right? So they're selling the stock first, and they're betting on, in fact, that the price of the stock is going to go down. And let's say they do this. Let's say they buy 10 million shares, okay? So they buy 10 million, or they sell 10 million shares at $5. So they've sold 50 million shares at $5. What they want to happen is, let's say the price goes down to $1, all right? And so what they'll do then is they'll buy the shares back, they'll pay off the loan, and they get to keep the difference, the $4, right, times a million shares, so they've made $4 million. Now, if it was, or 40 million, however many millions I said they were buying, but these hedge funds could buy up a lot. Well, what's happening though is that these people over here really like the GameStop share, and they trusted this dude, so they start buying more shares, right? The demand keeps going up, and the price of the stock started going up, and it went up exponentially, right? It went up by a factor of, I don't know, 40 or something ridiculous. And so what's happening is, traditionally what happens, if you're a dude like most of us at home, if you're a plumber or an electrician or a nurse or a doctor, or not doctor, but like a teacher like me, all of a sudden, let's say you've got 10,000 shares at $50 or $5, you've got 50 grand in the game. That's a lot of money, but now you've got 10,000 shares and the price is at $300 or $400. Now you got 400 grand that you put 50 grand in, now you're sitting at 400 grand. The pressure to sell off is huge. I would sell off because that's 400 grand. What 400 grand can, for someone like me, would be life changing, and for most of these people would be life changing. But homie here decided to get these fuckers, good fuckers, to hang on to it, and all that did was continue to drive the price up. At the same time, these people here who had to borrow money at $5, they were now openly, they had opened themselves up to all this unexpected leverage that they now had to take out more money to be able to cover the difference between the $5 they sold it off originally at to the $400, whatever it got up to. And so they were super, super over leveraged, and they had to borrow more and more money. It took one guy out of business, or a couple guys out of business, but it really fucked over a lot of really rich people, and the laws end up changing over this because you hate to have a rich hedge fund guy go out of business. That'll change everything. And so originally what you saw, if you saw the movie, you saw that they actually, some of the hedge fund and some of the people who worked together colluded to stop the sharing, to stop the price by shutting down the site for a little bit, which, is illegal, although it's very rare for rich people to go to jail over stuff like this. Have you ever seen Trading Places? They did the same thing at the End of Trading Places with Eddie Murphy and Dan Aykroyd, right? This 80s movie with Jamie Lee Curtis, where they go in and they short sell frozen concentrated orange juice in the commodities market. They sell it off at a high price and they buy it back at the end and they make the difference. That's kind of the end, fuck you, the Duke and Duke firm. So this is what happens with a short. You can also do a long where you're betting the stock is going to go up. A long is a little bit less risky because there's a finite amount of money that you can actually lose. When you short sell like this, particularly when you get a bunch of people who aren't selling off, these fuckers were not selling off, and it kept driving the price up. These people are getting squeezed, a short squeeze, where they were continuously having to borrow more and more money, open themselves up to more and more, losses. And it took the country by storm, the fact that people on the internet were able to galvanize themselves. But the problem is that when the people use the internet to galvanize the working class people, then the hedge fund guys lose out, and we can't have that. And so doing something like GameStop would be harder now. But this is what the internet could do. The internet has continuously let us down in terms of economic kind of our idea to flatten out opportunities for people. That's what Thomas Friedman idea of it. It has disappointed us over and over and over, but about 6 weeks, it was really entertaining. This is what the stock market and the internet can interact with, but the majority are just your average dudes who don't know anything that they knew before. So that's kind of what can happen. If you have more comments or you think I'm full of shit, just write that in the comments. I've had a couple people ask me about the Israeli Hamas stuff that's been going on. And so I said I would make a video about that and put it online too. So stay tuned for that.